Why does being added to an S&P index matter? When a company is added to an S&P index, funds that mimic the holdings of stocks within these indexes must rebalance their portfolios and purchase shares of the stock being added. This additional buying pressure often drives up the price of the stock. For smaller cap stocks with lower trading volume, being added to an index can also stabilize the price by increasing liquidity. The greater trading volume helps keep the bid and ask prices closer together. For all companies, the ongoing purchases by index funds can help prop up the share price over the long term. In addition, being added to an index raises the stock's profile with analysts, investors, and the media. This increased coverage can drive even more trading volume, often resulting in a positive impact on the share price. What is the S&P 600 index? The S&P 600 is an index that tracks 600 small-cap companies in the United States. These are typically firms with market caps between $850 million and $5.2 billion. Companies added to the S&P 600 are usually those that are increasing in value. This often happens due to positive financial results, indicating potential for strong long-term growth. Why companies get added and what happens next? Companies added to the S&P 600 generally have improving fundamentals, whether it's better earnings, stronger balance sheets, or growing revenues. These positive trends make them candidates for inclusion in the index, and being added is often a sign of stability and growth. After joining the S&P 600, it's common for analysts to initiate coverage on these companies. The addition of analyst ratings makes more investors aware of the stock. As a result, trading volumes often increase, which can drive up the stock price even further. How to trade this scenario? The average price move of stocks added to the S&P can be found in the table view of the scenario. Prices generally move quickly in after-hours trading, then often pull back before rising again over the course of several days. This creates opportunities for a variety of strategies, including intraday call-put options, trades, as well as simple buy and sell equity trades. Popular companies with high volume, like Tesla, tend to rise higher and for longer than less well-known companies. You can use the volume filter in the table view to screen for high-volume stocks. Note that the metrics in this area calculate price change from the close before an event to the close after an event. Often, stock prices peak midday before closing below the day high, meaning there's often more profit potential than the data may initially show. Important dates to understand. The date the stock is added to the index often differs from the date the announcement is made. In some cases, the inclusion date could be 4 weeks away. ETFs typically buy the stock before the inclusion date, while traders tend to buy after the announcement date. For example, Palantir was set to be added to the S&P 500 on September 23rd, but the announcement was made on September 6th. On inclusion day, the 23rd, there was a notable volume spike at the close on the 20th from both buyers and sellers. The total return over this 2-week period was 27%. Real-world example. A recent example of this strategy in action is Marathon Digital Holdings. On May 3rd, 2024, following the announcement, Mara surged 17.98% in after-hours trading. This illustrates how impactful S&P index inclusions can be, especially for companies with high investor interest. The win rate for this scenario is greater than 80%, making it a consistently high probability trade setup. Level Fields alerts users when a company is added to or subtracted from various S&P indexes. The platform also tracks how these changes impact stock prices in both the short and long term.